Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, gold has been on a fast lane, surging by 20% in the last year alone. Not just that, with geopolitical disturbances, many central banks in the world have, they're acquiring more and more of the yellow metal. Why is that happening, and is this the time for us to rethink our investments? We'll talk about that and much more with Dhirendra Kumar in today's episode. Welcome, Dhirendra.
Thank you.
So first of all, can you please explain to us why this surge in gold and why are the central banks going on acquiring more of it?
Historically, the US dollar has emerged as a global currency where global trade happens and they get settled in US dollar. And that is why, because it is a widely accepted trade, settlement mechanism, most central banks also hold it, and because they hold it, there's a natural demand from global, central bankers globally that they keep hoarding dollar, and anybody who has trade surplus is a substantial part of it is held in dollar only. The fallout of what happened in Ukraine was the dollar assets of Russia was confiscated, and the result of that is, we see the big shift. There has been historically, investors have been, or central bankers have been moving their money to gold besides dollar. But that acted as a great catalyst. Many countries decided that they need to have a larger gold reserves. And this is a whole new demand getting created for dollar, for gold. So gold was so far, substantially as we know it in India, is a store of value, is held in the form of ornament. It's held as a valuable thing, and people are comfortable holding it, and the value goes up. Even if it does not beat inflation, that's fine. The recent surge that has happened in terms of the new demand from central bankers, that has sustained. That is a phenomenal thing. That is exceptional. India is a great consumer, is among the biggest consumer of gold when it comes to domestic consumption. But of late, even the central bank, the Reserve Bank of India is also holding, is beginning to buy gold in large quantity. So the net result of all this is gold has been able to sustain. What happened, if I get into the history of gold, that the financialization of gold actually happened in 2008 or little before 2008 crisis. That was the time when it became possible to have gold ETF. That was the time when it became possible to have gold ETF, gold fund, and that created a new demand. And then it happened, and then it was followed by the global financial crisis. Global financial crisis was unprecedented. That was the first time when we witnessed that debt was crashing, equity was crashing, and the only thing which was able to hold ground was gold. And gold was able to hold ground at the same time. It was possible to hold gold without actually owning gold in your locker, or owning gold in the physical form. So that was one big demand trigger, which drove the gold prices around that time. And since then we have seen that gold keeps going up and down, and it has not been a great performer. It has been able to hold its value. It has been able to guard its worth, but it has not been an inflation beater, or it is not something which is so. That is why historically we have always held the view that it's not a productive asset. But this whole new demand and emergence of gold, almost like a currency, which people hold it and which can be realized or it can be sold at any time, and it will be able to hold its value, has led to this surge in prices, and looks like it is sustainable, because all the economies which will have trade surplus would like, even if they store or keep a part of it in the form of gold, I don't think it is ending.
And what if this is a fundamental change? This is not a momentary thing. If this is how it's going to happen now onwards, does that mean that investors need to bring about a change in their investment strategy?
Yeah, my sense is that this is not a temporary thing. This has happened, and because the American dollar has, there are a lot of things which are not very comforting about American dollar, the US dollar. So this surge for or the demand for gold or the money which has been deployed in gold by central bankers, I don't think it is a one-off thing. And if it remains a currency for the central bankers, then this might prevail. So my understanding is that it is today it has become something because of this factor, and the demand can still steadily keep rising. And if that happens, then I think one needs to fundamentally take a relook at. Historically, we have said that don't consider gold as a productive asset. So you can do without having it. I've always said, even around Akshaya Tritiya or any such occasion, that think of gold as a consumption. Think of gold as have a notional thing, keep it. Then it is also part of our customs. It is considered as a Sridhan or whatever, and for a variety of reasons we hold it and have it to that extent. Have it to to show off. Have it to have a stylish jewelry for yourself. But don't think of it as an investment. Today, because it has been, because of this new demand which is likely to prevail, it might be able to hold its value. It might be able to guard its value and also go up in value. So, if one can have some allocation to gold.
Okay, so for someone like me who does not have any investment in gold so far, what would you suggest? What is the best way to invest in gold?
The best form of gold ownership is to actually have sovereign gold bonds, because this is where you not only are able to ride the prices of gold as an investment, because not only are you able to ride the price of gold or price appreciation, but you also get interest on that, an annual interest. Not only that, if you hold it from an original, if you buy a gold bond issuance, sovereign gold bond issuance at the outset and hold it for 8 years, all the appreciation is tax-free. So that is a significant advantage. Appreciation which is tax-free, which is guaranteed by the government, and you not only keep gold, you are able to ride gold without any of the incidental risk of owning gold in your locker. You don't have to protect it. Then there are no management expenses. If you buy a gold fund or a gold ETF, there is an expense ratio to it. So the return on that will be the return on gold, the appreciation of gold minus the expense. Here, the return on gold prices plus the interest that you earn.
Okay.
So that is the most beneficial form of gold investment.
All right. And what proportion of your investment should be invested in sovereign gold bonds?
I'm still not very, there isn't a thumb rule. But if you need to de-risk yourself from equity and debt, then you should have 5%, 3%, 8%, depending on your own or your own belief in gold. You can well have gold, but not more than that, because I would say that fundamentally it remains an unproductive asset. I would even if it is a currency, I would not like you to own dollar in your locker. And that is why I would not like you to own, rupee kept in your locker, because it's not working hard. But gold might appreciate a little better. So you can have it, and for a variety of external reasons. But beyond that, it should not be any significant part of anybody's portfolio.
All right, then that's about gold as an investment in your portfolio. Now, here's a question that Vishal Kichlu has sent. He asks, how are arbitrage funds for parking surplus amount for short term, that's 1 year? Is there any better alternative?
Arbitrage funds could be a decent parking ground entirely because of its tax efficiency. Arbitrage funds, by its design, are treated as equity. And by its character, they're almost like a liquid fund. Because here the fund manager is buying a share and selling the future contract and is trying to derive the return from the difference. So it is like an equity fund. Tax-wise, it is treated as an equity fund. And when you hold equity for 1 year in the form of a mutual fund, then your taxation rate is 10%. So if you invest in a liquid fund, I'm just saying it for illustrative reason, that 10% appreciation in a liquid fund and 10% appreciation in an arbitrage fund. Here, the tax will be 10%. And there, in a liquid fund, it will be added to your income and you will be taxed accordingly. So that it is tax-wise, it is efficient, it is able to get you, and you are not exposed to the equity market risk.
Okay, and is there a better alternative to this?
Depends. If you are able to, if you have a sense of your time frame, then might as well consider. Many people think of, there are multiple reasons why you need fixed income. An arbitrage fund will actually qualify as a preferred mode of risk-averse investment. And if you look at the alternative, liquid fund is one. Money for few days, money for few weeks, it should be parked there only, not in an arbitrage fund. Money for, tentatively, you need the money, but you don't know when. It could be 1 year, it could be 3 years, it could be 1.5 years, it could be 2.5 years. If the money is like that, then if it is less than 3 years, consider arbitrage fund. Money for 3 years and more, but you don't want to take great chances, but you would like to optimize your return, then consider a conservative hybrid fund. If you want to just not take any chance with your money and 3 years and more, then maybe a short-term debt fund or a conservative hybrid fund. These are your options.
All right, then. That's all we have for you in this episode. Keep watching the space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.